Assalamu alaikum. Welcome to day 13 of Performance Management Revision Crash Course. And today we are going to cover performance measurement and control. Here we are going to go through overview and ratio analysis and some non-financial performance indicator. So, in your performance management, know this very well that this is a key topic and it is going to be tested in detail. It has always been tested in detail in all of the exams. And effective system of performance measurement is very critical if you have to manage your investments, your division, or the managers. So typical measures are profit revenue margin, share price if listed, ratio analysis, return on investment, return, residual income for division, variances, and non-financial measure. Very important. So you should know both financial measure as well as non-financial measure. Okay, these are the performance measurement. This is how you control. So for this, you should know how to calculate and interpret ratio analysis. Okay. Remember, ratios, they are not representative of the position throughout the period. It keeps changing. So you have to see the seasonal trend. And you need to compare. Ratio analysis is always useful when you have something to compare it with. If you compare profit, if you calculate profit margin, you cannot say whether it is good or bad unless you don't compare it with your competitor or the same entity across a period of time. So you can compare it with the budget to control. You can compare it with the last year's figure to identify trend. You can compare it with the competitor or industry to assess your performance against the industry. Ratios can be manipulated because you need accounting uh, formulas to calculate ratios, and any accounting figure could be manipulated. And ratio does not give you an answer. Ratio just gives you a hint that you have to further investigate this area. Okay. So ratios are divided into separate sets. Okay. The first set is known as profitability ratio. Here it measures profits, but there would be so many formulas to do that. First one is return on capital employed, ROCE. Very common ratio. Everyone should know it. The formula is net profit divided by capital employed into 100%. Okay. There is another way of calculating ROCE which will come to bit a little later after we finish net margin and asset turnover. Next one is net margin into asset turnover will also give you ROCE. But for that, you have to know both your net margin first and asset turnover. So the next is gross margin or gross profit margin, where you take your gross profit. Gross profit is your sales minus cost of sales. Gross profit divided by sales into 100%. Next is net margin. That means from your gross profit, you deduct all the expenses, comes net profit. So net profit divided by sales into 100. Asset turnover is your sales divided by capital employed. So this net margin and asset turnover is what you multiply and get ROC, the first ratio. Second set of ratio is liquidity ratio. Liquidity ratio measures how, like, your position to repay back your liability, having your assets. So first ratio is current ratio, where you take your current assets because the word says current. So we take current assets and current liability. We divide them. If the ratio is more than 1, it's good. You are safe. If it's less than 1, it shows that you have liability more than assets and hence you're struggling to repay back your liability, your debt. Next is quick ratio. In quick ratio, you take the inventory out from the current asset. Why is that? Because it is believed inventory is not so liquid. Inventory is the least liquid in the current asset. If you take cash, debtor, they are more liquid. They can be turned into cash very easily. But inventory takes a long time, okay, to be turned into cash. They are least liquid. Liquid means how fast you can convert something to cash. So inventory is least likely. That's why we take inventory out. This is also same. If you want to take the ratio, more than 1 is good. If it's less than 1, it's not good. But if it's too high also, both current and quick ratio is also not good, because that means you're tying so much of cash unnecessarily in current assets. You might have invested it somewhere else. So the ideal ratio is set to be 1 is to 1 or 2 is to 1. Okay. If you're having 5 is to 1, that means current asset 5, liability 1. It's good. You're liquid, but too high is not good. Maybe that cash you might have used it somewhere else to invest. Okay. The next three will help you in your working capital. What is your working capital? Working capital means current assets and current liability, right? So your assets is receivable and inventory, liability is payable. So working capital you will get when you add your receivable with inventory minus payable. So for this, we have to calculate the days, receivable days, payable days, and inventory days. They are known as working capital ratios. The first two, current ratio, asset test, are liquidity ratios. Okay. So receivable divided by credit sales. Now, when you are taking sales, be very careful. You should not take cash sales. Sometimes they will give you the division, cash and credit, sometimes total sales. If total sales, then take the total sale. If they tell specifically that this is cash, this is credit, take credit sales only. Now, what is the logic behind it? See, in your exam, you should not explain the logic, right? You might tell me that it's not very important. Then why do I teach you logic? The reason is when you learn something with logic, it's more fun, number one. Number two, you will remember it better. Okay, my students tend to forget less when they know the logic behind something. Usually these are not taught in school because no one asks also, and teachers also don't take so much of time out to explain. But I do that because that's how I used to learn, and I used to learn it better. I mean, no one used to teach me, but I used to take my own logic and So credit sell because receivable only comes when the sales are on credit. Otherwise, receivable will not come. Same for the payable. When we are taking payable, it's payable divided by credit purchases. Only when you purchase on credit, only payable comes. Otherwise, there'll be no payable, no? You just pay in cash, everything is settled there. Into 365. 365 because we are calculating days. So in a year, there are 365 days. So let's say from your receivable, you are getting 73.5 or 73.4 days. Better to round it up to 73 or 74 days. Okay. I would say round it up to the next day, 74 days. So don't take in decimal, take whole number, 74 days. That means it takes 74 days for your customers to pay you back. You are going to compare this with your payable day. Are customers paying late or you are paying early? So payable days, how long are you taking to pay back to your supplier? Inventory. So it's inventory divided by cost of sales. When you're taking inventory, take closing inventory. Okay. Then cost of sales. If they don't give you cost of sales, then opening inventory plus closing inventory divided by 2. Okay. That also you can take into 365 days. So everything is into 365 days. That means how long are your inventories taking time to be sold off? Okay. So having higher receivable is not good. It means too much. You are not receiving the cash that you should have received. To having too high inventory days is also not good because it's a cash outflow, right? You are investing. I mean, it's a cash outflow because you have to buy the inventory, and having two payable. I mean, a high payable day is good and bad both. Good because you're delaying the cash payment for, I mean, that cash is still there in the business, you can use it for some other purpose. Bad because if you are paying too late to your supplier, next time they might withdraw that credit limit from you or relationship might get worse, right? So measuring risk. Next type of ratio sets are divided into measuring risk. They measure the risk. This is very important for your AFM and FM, financial management. Okay, in detail it's there. Here you need to know the formula. So financial gearing, it measures how risky financially you are. Okay. To finance any company, we need debt and equity both. Equity is our own capital, debt we take from outside, right? So debt equity, that ratio we find. What is our equity ratio of debt to equity? If debt is more, it's not good. It's good and bad both because debt attracts interest, tax relief. Because on debt you have to pay interest, it attracts tax relief. It's good, it makes debt are cheaper than equity. In a way, it's good. You can get it faster also. But then you have to pay back also the interest. There's an obligation. For equity, whether we pay dividend or not is not an obligation. Okay. So in terms of that, if you take, it's less risky. Equity is less risky than debt. There are two ways of calculating this. Either debt divided by equity or debt divided by debt plus equity. Anyway. Next is dividend cover. With your net profit, how much profit dividend are you able to pay? So net profit divided by total dividend. Then interest cover. Operating profit divided by interest. Okay. See, for interest cover, we are taking operating profit because interest and tax are deducted after operating profit from operating profit. So before we deduct interest, we take that operating profit and divide by interest. For dividend cover, we are taking net profit that comes after deducting interest and tax. So from operating profit, we deduct interest and tax, and then whatever is remaining, we pay as a dividend. You understanding? That's why we take for dividend cover net profit, for interest cover operating profit. Now, non-financial performance indicator. With that financial, you need this also. Total picture, right? So you need a balance between both financial indicator and non-financial indicator. Financial indicator, you can get it through ratios. What about non-financial? You might think, why non-financial? If through ratios I can get? No. Ratios only give you one figure. They don't tell why the problem occur. Why this ratio is too high, why that ratio is too low, why the ratio decline, why the ratio improve, why it is stable, why it does not answer those questions. But when you see financial performance indicator together with non-financial performance indicator, you get a better picture. Understanding? For example, financial performance appraisal reveals the effect of operational factor, but the causes they don't say. For that you need non-financial indicator. Next, the achievement of this goal is monitored using a number of measures, many of which are non-financial. To achieve your financial goal also, you have to achieve many objectives which are non-financial. How can you improve sales? Your sales figure? Only if your customers are satisfied, right? So your customer satisfaction is a non-financial measure. A firm's success usually involves focusing on a small number of goals where they must win. This is one example of non-financial performance indicator. Now, stakeholder. See, different stakeholders have different objectives. Companies have to deal with this range of performance measure. Okay. Now, for non-financial performance indicator, we have a model which is known as balanced scorecard. It is scorecard because we give score to these 4 different areas, and we'll add up and see the total number. It is balanced because it is balanced across these 4 areas, which is developed by 2 people known as Kaplan and Norton. That's why we say Kaplan-Norton's balanced scorecard. Name is not so important, but you should know the model is balanced scorecard. It measures the non-financial aspect as well as the financial aspect. That's why the name is balanced. Okay, so first one is financial perspective. This answers the question, how do we look to shareholders and lender? Both are important, no? From shareholders equity, from lender debt portion. Next is customer perspective. How do customers see us? Third is internal business process. What must we excel at? And the fourth is innovation and learning. Can we continue to improve and create value? So your performance is judged across these 4 areas. Now, what is the balance of this balanced scorecard? Number 1, it takes external as well as internal information. Right? Internal process that you must excel is internal. Your customer is the external information. Next, not only financial, it looks in the non-financial factors also. Problems is to select the measure. It's critical. To obtain the information, again, is important. Information could be overloaded, and between measure there could be conflict. For example, you want to achieve the financial measure, but it is not conflicting with your internal process. Next model is known as building block model. Just see, it looks like a building and it looks like a block, right? So over 2 blocks, there's a one bigger block that is built up. That's why the model is building block model. Person is not important. I've mentioned the name of the person who have made up this model in bracket. Name is not important. So first is dimension. Under dimensions, we are going to see through financial performance, competitive performance. These are similar to the balanced scorecard. Okay. Quality, flexibility, resource utilization, and innovation. That means for any company to succeed, they have to perform well in all this area. Financially, they have to perform well. With competitors, they have to perform well. In terms of quality, they have to excel. Flexibility, they have to have the resource utilization, and they have to innovate. Next is standard. To innovate, to perform well, you have to own, you have to achieve, you have to equity. And then reward. There should be a system of reward as well, which should be clear, which should motivate you, and which should be controlled. So now we'll explain this in detail. For dimension, these are source of goals. Okay, your dimension will give you the sources of goal. What is your goal? To improve quality, to be more flexible, to innovate. Next is standard. Will give you the measure through which you can achieve your goal. And to ensure success, employees have to view the standard as achievable and fair, that is equity. And they should take ownership of that also. Third is reward. To ensure employees are motivated to meet the standard, your targets have to be clear and it should be linked to controllable factor. Now, the questions are pinned: CIM, Rotec, Flag Company, Pest Night Company, Hem Honk. Thank you for watching, and just 2 more days are left, that is day 14 and day 15. So if you have missed out on any of the previous days, you can watch it under the playlist PM Revision Crash Course. You can also download this PPT slide from my channel in the About section. Click PM Revision Crash Course and download all the slide. Thank you and take care.